So really to just put it at its base, the biggest issue is that carriers are very concerned about long-term profitability. So then we want to try and understand, well, what is it that's impacting that profitability? The primary driver has been what's called social inflation. And this is the concept that claim inflation has far exceeded the pace of typical inflation on goods or services. To say it another way, a slip and fall that may have happened 5 years ago, and there would have been an insurance payout of, let's say, $50,000. Today, because of social inflation, that payout might be $200,000. So that increase in the cost of claims has been the biggest hit to carriers' profitability. There are some other factors that are very much in the focus of carriers as well. Just to name a couple or a few, changes in legislation. So in the last couple years, there's been legislation that's been enacted to open up the statute of limitations dealing with claims from when people were children. In New York, it's called the Child Victims Act. There's many different states that have enacted similar legislation. So carriers have concern that the opening of statute of limitations is going to increase the number of claims that they get. Those claims are going to cost additional money, which is going to impact their profitability. A few other things to name: economic uncertainty, wage and commodity inflation. So if a carrier is going to insure a building, the cost to replace that building is going to be significantly more today than it was just 12 to 18 months ago. And last but not least, market volatility. So many insurance carriers have investments, whether it's in the stock market, bond market, et cetera. The volatility around those investments has an impact on their profitability, which can have a downstream impact on the pricing of insurance policies.